my top 4 dividend stocks in the industrial sector. So starting things off, we got the conglomerate in 3M, which by the way stands for Minnesota Mining and Manufacturing. And 3M is just a huge conglomerate that runs under 4 business segments. We got their safety and industrial business segment, their transportation and electronics, their healthcare, and their consumer business group. Now, these 4 business segments for 3M are pretty diversified and pretty well-rounded when it comes to the percentage of their net revenues, and they also have over 30 billion in revenues, which just gives you an idea of how big this company really is. Now, as far as their dividends, they have been paying and increasing their dividends for 61 consecutive years, and this is the highest stock in my portfolio as far as having the longest dividend increase streak. Now, as far as their dividend right now, they are paying $5.88, and at current prices, that does give you a starting yield of above 3.5%, which is well above their 4-year dividend yield average. Now, as far as earnings, we do have the projected 4 quarters for 3M coming up, and as you can see, Q2 and Q3 are going to be down quarters for 3M as far as earnings per share, but that is kind of expected with the current environment that we're in. Now, as far as for the next 4 quarters, they are projected to do $8.14, and with their payout at $5.88, that gives them a payout ratio of 72%, which I do think is a little bit high, but you also have to consider the fact that 3M has been paying their dividend for such a long time, and their management team is definitely dedicated to continue to pay and increase that dividend. So I'm not too worried about their payout ratio. I do think that over time, let's say over the next 6-8 quarters, once their earnings start to pick back up, that payout ratio will come down. Now, as far as their valuation, they do have a 5-year average PE of about 21, and I think a good buying opportunity for 3M has always been under that 20 forward PE, which would put the stock, at least right now, at the 154 level, and the stock is trading, I think, below 160, which is pretty close to this range. However, I don't think I'd be buying any more 3M shares, at least at the moment, just because with 3M, it seems like they're always restructuring their business and their portfolios, but it is a good thing because they do divest out of certain businesses in their portfolio that just aren't as profitable as other businesses. And for 3M, the name of the game right now is just to continue to increase their earnings so they can go ahead and continue to pay out shareholders. Now, as far as my position in 3M, like I said, I don't really want to buy any more shares of 3M, even if it does come down in valuation, just because I look at 3M as a dividend anchor in my portfolio. I kind of just own the stock for the cash flow and for their excellent track record when it comes to paying and growing their dividend. Now, I do think above 2% of my portfolio is a pretty good percentage. However, if it does drop, I might consider buying in a few more shares. They do have their upcoming earnings call for Q2 coming up next week, and that could bring up an opportunity to maybe pick up a few more shares, at least for my portfolio. Now, as far as their earnings growth for the next 5 years, they are projected to grow at about 2% per year, and that's another reason why I wouldn't really want to build out this position too big. It's kind of like an AT&T and a Verizon. They don't really have much growth prospects moving forward, but they do have a good dividend. Moving on, we got Raytheon Technologies, which is the company that came out from the merger of United Technologies and Raytheon on April 3rd of 2020. And basically, this company is divided into 4 business segments. Number 1 being their Cummins Aerospace, and number 2 being Pratt & Whitney. Now, these 2 segments are from the United Technologies company, and then their next 2 segments, which is Raytheon Intelligence and Space and Raytheon Missiles and Defenses, that came from the Raytheon company. And now with the merger, all these 4 segments are into one business, and we can see here their Q1 of 2020, their first earnings call as Raytheon Technologies. They went ahead and broke down the 4 business segments, and I think they're pretty well rounded. You got the Cummins Aerospace and Pratt & Whitney accounting for about 60% of the revenues, and then the Raytheon side about 40%. Now, as far as their dividend track record, they have been paying and increasing their dividends for 26 consecutive years. And as far as their dividend right now, they are paying $1.90 per share, and you do have a 3% yield if you get into the stock at these current prices. Now, as far as their earnings, we do have the next 4 quarters for Raytheon here forecasted, and as you can see, these upcoming 4 quarters are going to be really rough for Raytheon. They're projected to do just $2.30 over the 4 quarters, And if you take a look at their payout ratio, which was at $1.90, they have an 82% forward payout ratio for the next 4 quarters, which I do think is a little bit concerning. But if Raytheon could survive these upcoming 4 quarters and slowly get their business back up and running, I do think they'll be just fine. Now, as far as valuation, they do have a 5-year average PE of about 17. But as far as me buying the stock, honestly, I wouldn't be purchasing the stock right now. I think they have a lot of downward pressure on the stock, which we'll go over in just a second. As far as Raytheon in my portfolio, I do own 14 shares of Raytheon Technologies. I actually picked up these shares when they were just Raytheon before the merger. And quick note, my average cost is not $11.40. It's more like $69, but Robinhood didn't really update that information after the merger. But besides that, I do want to point out that the reason why I wouldn't buy this stock right now is because they have a lot of downward pressure on the company. Number one being the virus, as the virus has definitely slowed down air travel. And when it comes to the Collins Aerospace and Pratt & Whitney side of their business, they pretty much rely on air travel. And number two, the fact that the 737 MAX of Boeing has been grounded since March 2019. That has been a pretty big hit for the Collins Aerospace segment specifically, which does a lot of work on the 737 MAX for Boeing. And then lastly, we did have new tariffs on steel and aluminum that were placed in January of this year, and that's going to be increasing the cost for Raytheon and hurting their earnings potential moving forward. So as far as the stock, I really don't like it right now, but since I did own it before the merger, I'm kind of stuck holding it right now, but I don't have any intentions on selling it just because I do see the long-term vision of the stock as now being the 3rd largest aerospace company. I do see Raytheon to get back to normalized earnings. And as far as their earnings for the next 5 years, they are projected to grow at a negative 13% clip per year for the next 5 years. But keep in mind that that negative number is mostly due to the fact that last year they did report, I think, about $8 or $9 in earnings per share. And this year is going to drop significantly to about $3 per share. And then from there, it's just going to grow very slowly, but I don't think it's going to get to $9 or $8 by the end of 5 years. Moving on, we got the company Cummins, which is the manufacturer of diesel and natural gas engines. And Cummins is a pretty big company. They are divided into 5 business segments. They got their engine side, which accounts for about 34% of their revenues. They got their distribution, their components, power systems, and their new power segment, which, as you can see right now, doesn't really contribute to the top line of Cummins all that much, but I definitely think that is the future, as that's their electrified power segment, which it's pretty cool to have a company like Cummins, because right now diesel and natural gas is what we mostly use for transportation, but I do think that down the line we will be moving to electrified power, and Cummins is positioning themselves well for when that time comes. Now, as far as their dividend history, they have been paying and increasing their dividends for 14 consecutive years, and their dividend right now, they are paying $5.24, which gives them an opening yield at current prices of just under 3%, which is just a little bit higher than their 4-year dividend yield average. Now, when it comes to earnings, we do have the projected 4 quarters for Cummins. And as you can see, these next 4 quarters, just like Raytheon, are going to be really rough. They do also have some downward pressure on their business, which we'll get to in a second. But for the next 4 quarters, they are projected to do $7.24 per share. And that gives them a forward payout ratio of 72%. And that is, again, a really high payout ratio. But here's the thing with Cummins. For 2021, they are expected to get back to normalized earnings of around $10 per share. And that's going to drop their payout ratio significantly back to that 50-55% range. Now, talking about valuation, they have a 5-year average PE of about 15, and I think a good buying opportunity for this stock was a long time ago when they were trading at around $100 a share, which gives them a 13 to 14 forward PE. Now, the stock is trading at around 180, and thinking that the stock is gonna drop down to 100 is pretty crazy, and I don't think that's going to happen. But I wouldn't buy the stock right now as it's trading at a forward PE of 25. And I feel like investors are saying, well, 2020 is going to be a poor year for Cummins. Let's value the company using 2021's earnings. And if you do that, then they are trading at a 2021 forward PE of 17, which makes it a little bit bit more feasible as far as valuation, but in my opinion, I don't like going out that far out as far as forward earnings. I usually just like to look at the next 4 quarters. And if the upcoming 4 quarters don't make much sense as far as valuation, I'll go ahead and be patient and I'll pick up some shares once the valuation makes a little bit more sense. Now, as far as Cummins in my portfolio, I do own 4 shares at an average cost at around $139. I did buy this stock quite a bit of time ago, and I do regret not buying more shares on the dip in March and April, but hey, you can't really buy them all, so I'll be waiting for this company to drop in the future to build out a bigger position. Now, as far as their earnings for the next 5 years, they are projected to do a negative earnings growth for the next 5 years. And again, that's kind of like Raytheon. They did report a really high number in 2019, and then now in 2020, since they're going to take this huge earnings hit, they're going to be growing their earnings a little bit slower, and they might not reach the 2019 earnings by the next 5 years, which honestly might be a little bit off. I wouldn't be surprised if they do beat that growth rate of -4% for the next 5 years. And lastly on the list, we got Union Pacific. We got the railroad company, and Union Pacific is pretty much broken down into 3 operating segments. They got their bulk segment, which includes the transportation of coal, renewables, grain, fertilizer, and food and beverages. And this segment accounts for about 31% of the revenues. Then you got the industrial segment, which includes industrial chemicals, metals, minerals, and that's about 39% of their business. And then lastly, you have their premium segment, which is more in the automotive side, and that accounts for about 30% of their revenues. Now, as far as dividends, they have been paying and increasing their dividends for 14 consecutive years, which is a really good track record. Now, as far as their dividends right now, they are paying $3.88 per share with a starting yield of just over 2% at current prices, which is in line with their 4-year dividend yield average. Now, as far as earnings, we do have the forecasted 4 quarters, and as you can see, Q2 and Q3, kind of like the other companies on this list, is going to be a rough Q2 and Q3 for 2020 for Union Pacific, but they are projected to do $7.70 per share for the next 4 quarters, and with their payout at $3.88, and that gives them a payout ratio of 50%, which is actually really good, especially comparing them to the other stocks. Now, as far as valuation, they do have a 5-year average PE of 17, and I think a good buying opportunity would be at that 15 to 16 forward PE, which would put the stock at the 115, 123 price range. And right now the stock is trading in the 180s, and kind of similar to Cummins, I do think that they're overpricing Union Pacific, but as it is right now, they're trading at a forward PE of 23, and if you use their forward earnings of 2021, they're trading at around a 19 forward PE. So either way, I do think the company is a little bit overpriced and a little bit overvalued right now, so I wouldn't really buy the stock. They do have their Q2 earnings coming up, kind of like 3M, and maybe after that earnings call, we could see a buying opportunity for this stock. Now, as far as my position, again, I don't have Union Pacific, but I do think I might add this stock if the opportunity presents itself. I have been looking into this company recently, and I think it would be a great addition for my portfolio, at least for my industrial sector. I think the best company I have in this sector right now is Cummins, or at least that's the stock I'm most bullish on. But when it comes to 3M, there's not really much growth potential there. They do have a great track record as far as their dividends, but again, their business is not going to really grow all that much. And as far as Raytheon, they're definitely in a tough spot right now. I do think over the long term, they are going to be a very well-performing stock, but right now, they're not in a good spot. So I think Union Pacific, since they do have a good mixture of growth and stability, I think it would be a good addition for my portfolio. And as far as growth, they are projected to grow their earnings at about 8% for the next 5 years per year, which I think is really solid. So those are pretty much my top 4 dividend stocks in the industrial sector. We talked about 3M, Raytheon, Cummins, and Union Pacific. Hopefully the video was helpful, and thank you so much for watching.